Gracias. Thank you, Steve. Thank you, Julian. And I'm going to try to summarize some bullet points because you guys are the expert and people don't want to hear me speaking and speaking. So the bullet points that we're seeing today is that the market perhaps are under pressure because of data. You have today, Thursday, lower jobless claim coming down and an outward on the GDP revision. On the corporate earning, we have a very bad thing coming from CarMax, clearly disappointing the market. And obviously on the housing is very conflicting because we have on the CPI reading shelters coming down, but on the actually data on the housing prices are coming up. On the real growth, I think the problem that the government have, and I want to hear you both, is that the jobs creation is coming from the government, and obviously that creates some sort of anxiety. And the other thing I want to lay out for you guys is the anxiety with technology. It looks like it's a conspiration where people or companies are buying each other and try to realize that everything is going very nicely, but we know that it might be some issues. And last but not least, what's happening with the stable coins and so on. So I want to start with you, Steve. I wonder if you can give us a kind of an opportunity to understand what are you seeing for the fourth quarter in the market. And obviously, thank you for coming to this nice podcast.
Well, first of all, always glad to be here and with Julian to talk about, discuss the market for the viewers in a very simplistic way as opposed to a quantitative way. One of the things that you mentioned, which was fascinating, was about CarMax. One of the indicators that I look at is auto loan defaults. All right. It's a very, very important number. So we're seeing that auto loan defaults, meaning the public doesn't have the ability to pay their car loan. It's very high right now. It's not as bad as 2008, but it's telling you something about fear. So when there's a disconnect between Wall Street and the public, that's where panic starts to develop, and therefore potential value. And by seeing the market come off here, which is understandable, it's taken a massive move to the upside. Nothing can go straight up, not even Oracle. All right, not even Oracle. And they're in the process of issuing some bonds right now. It's not like they need cash. They must have a reason why they're doing something. But what I'm seeing right now is I look at the auto phone defaults, and I also look at the speed of the endorphins as the stock market gets somewhat gamified.
Julian, this is for the institutional guys, for PMs, analysts, actually the stakeholders in the market that are seeing this from the US and Latin America. And also it's going to be seen by your peers because you are with myself and a character. Thank you for coming. What do you think about the overall aspect of the market, Julian?
Well, thanks, Victor, and nice to be on again with you, Steve. So I think, look, my concern has been the following over the last few months, that we are pricing in what I would call this perfect Goldilocks outcome. So what is Goldilocks? So the story tells you it's not too hot, it's not too cold, it's just right, Victor. So what we want is a not too hot inflation, right? It's transitory. And at the same time, we don't want too cold a labor market that the labor market loses momentum, rolls over, and we get a recession, because that's typically what labor markets do. When you look at the rate of change of unemployment, it is typically rising or falling. It rarely tracks sideways for an extended period of time. And the problem with that is that gets challenged by, so we've run that very extensively, right? We've priced in at one point 150 basis points of rate cuts into the curve. And that gets challenged when you get stronger economic data, right? So today we had data that just wasn't quite just right enough. It was a little too hot, right? Because we have this narrative that the Fed is going to cut a lot because the labor market is weakening. And the reality is we have this very bizarre labor market. We have a labor market where essentially we aren't hiring, but neither are we firing. And that you can see in the claims data, right? So to Steve's point, this all comes as we've run up valuations to extreme levels. we've been saying to clients that we've been a little worried about the lack of weakness in the dollar. The dollar had been weak, had been driving a lot of these kind of reflationary trades, move into emerging markets, the move into the things like the Russell, move into some of the precious metals and commodity space. And today we've seen the dollar bounce. Now, I don't think it's the beginning of renewed dollar strength. I think the administration structurally wants a weaker dollar. I think ultimately they will achieve that, Victor. But this is just part of that kind of indigestion process that we're seeing. We are priced for a scenario which historically, Victor, if you go back and you look at history, now the Fed will claim that they've had 4 soft landings in the last 10 tightening cycles. Honestly, I think they've had 2, right? 2. So the odds of a Goldilocks soft landing are 20%, and yet the market was all in on that scenario. So they're betting on a really, really long odds.
Absolutely. Listen, and obviously, you know, I think, Steve, you are in the same vision with Julian. And I don't know if you can articulate to the audience, what is your perception that we might see some recession? For example, there is a contrast between the positive GDP and the private sector contraction that we're seeing up to some point. Because at the end of the day, I think everything is relying on the government, and there is some analysts out there. Remember, we are seeing data previous or recording this previous to the August PCE that is going to be released tomorrow. I want your opinion about what do you think about recession? That is something that people is not willing to accept that it will be a possibility. But if you hear Julian, maybe we're going into that direction.
Let me say this. I agree on a very strategic point that Julian said. There is a very high likelihood that we, you know, if you look at what Jamie Dimon said, you know, no more than a month ago, the banks are on a tipping edge, all right, in many respects. Remember, the data that they have on a day-to-day basis and the size of these institutions, they're fortunate to really look at things really from the outside in and the inside out. I mean, when you saw Jamie Dimon invest in Planeteer a decade ago, not 2 years ago, a decade ago. So they do have foresight, but they keep their cards close to their chest. But my main concern for the public, because I want, you know, the viewers, you know, need to understand, at least for me, I want the viewers to understand how there's a disconnect between institutions and retail. Right? Institutions can stay into a position for years. They're not in it for a day or a week. And it is virtually impossible to time certain parts of the market. Virtually impossible. And the gamification of the markets and the social media behind the market. So there's a new normal. So things could be very skewed very quickly. We're seeing that. I mean, look at, you know, the Commerce Secretary and Bassett and Trump, you know, throwing out the idea, instead of reporting quarterly, we'll do it semi-annually. All right. And it's interesting on how they thought that process through. Not that it's wrong and not that it's right. I'm not opining on that, but it comes back to the basis of what? People who have capital have one thing: time. And when you have time, you develop trust, all right, with any institution. And when things go down and the market doesn't go their way, okay, whether it's a big hedge fund or a big pension fund, they're in it for the long term. And that's what it really comes down to. Value is perceived on what it is, psychologically, and also emotionally when it comes to risk for any investor, whether it's an institution and or an individual. And that's what the public is starting to see right now, the element of fear.
Absolutely. And obviously, Steve, it's pretty interesting because one of the things that I want to obviously going to ask Julian first and then yourself is the anxiety with technology. We've been seeing these magnificent sevens that actually are magnificent five for me or magnificent four. But now we're seeing the case of NVIDIA creating some sort of what they call the Cisco-like bubble, which is heavily financing its own customers. So I want you to tell me, what are you seeing in the data, Julian, because I know you relate a lot on data correlations and what's going on there compared with perhaps 2000, perhaps other kind of crash back in the days. And there is an anxiety that you will see a crash, not right now, but at some point will be something extremely annihilated. And obviously we don't kind of rule out any geopolitical events, anything on China and Taiwan. And obviously we're not entering into that. We're entering into valuation and super heavy valuations. But what do you think about technology? What you can tell the audience of what to expect in that very interesting bucket in the market?
So look, I mean, there are, nothing is ever quite the same. I lived through, the dot-com bubble and a number of other, the '08 scenario. And look, there are material differences that you can draw attention to, right, in terms of the profitability of some of these companies, free cash flows, all that sort of stuff. But at the end of the day, a bubble is not a function of cash flow. It is a function of herd mentality, Victor. When everyone owns the stock, when everyone is long, there is literally no other way for the stock to go or the asset price to go. It has to go down, right? Now, you can make the case, yes, but there's always new money coming into the market and so on and so forth. But it doesn't quite really work like that, right? So I think there is definitely, you can see the, that froth starting to build, right? We are incredibly dismissive of anyone who has a contrary view at this point. I was listening to a very interesting podcast about quantum computing the other day, and there were two guys junking it out. And there was a true quantum computing expert, and there was some millennial, influencer who was interested in pumping up the stocks. Now, he's won in the sense that the stocks have gone up, but it doesn't mean that he's right about his thesis behind this, right? So I think there's a really bit of a danger here, as I said, in exactly the same way that we have with the Goldilocks narrative, that we are creating narratives to fit price action, right? These things are going to do what they're going to do because the price is going up. So obviously that has to be the case. Now, I am not for a minute arguing that AI won't be transformative, right? But the question is, and my concern all along is, I think that Google and Amazon and Meta are investing in AI because it's essential to their existing business. If you want to remain the number one in search that Google does, you have to spend on AI. If you want to remain the number one in social media, Meta, you have to invest in AI. It doesn't necessarily mean, though, Victor, that you generate some completely new cash flow, right, or revenue stream that justifies that ROI. And that's all I'm at this point concerned at. I am looking for the point where everyone is long, and I think we're increasingly getting to that point. Don't think we're there yet, right? I think it would be where you really would get worried if you get one of these true parabolic blow-offs, and we may be in the early stages of that now, okay? And the point where the penny drops, that these ROIs are not exponential, right? That's when you end up with a problem.
Listen, one of the things that I realized when I'm doing these interviews and podcasts and speaking with guys like you, professionals in the money management markets and stuff like that, is that we, the institutional guys, we don't have the time to see everything. And at the end of the day, what we want to hear is some sort of a forecast. So I want to hear you, Steve, about, obviously you were mentioning something about Oracle, and they are perhaps going into the market to raise some debt. and the red flag that that can create. If you can articulate a little bit on actually technology will be great. But if we can start talking with both of you about the asset class for Q4, and I know it's difficult because you have a rear mirror, you have a dashboard, we don't know where this is going, but this will be seen by guys in the region that are relying on your expertise and the fact that they should be invited to see these podcasts. So they want to know, what do you guys think about gold? What do you guys think about obviously the Bitcoin? What do you guys think about the other asset classes that at the end of the day, with the 10 year, 30 years and everything, is what they are doing in their own kind of portfolio management scenario. So if you can tell me about technology and then start forecasting, what do you think? I know it's difficult, Steve, but that's what the people is wanting to hear for guys like you.
Let me say this, okay, and I really say this with a lot of conviction. The public has a very short-term memory, and I'll give you a classic example. 2 years ago, the low on Meta was like 87, but people forget, all right, that it went from 350 to 87, and then look at where it is. Okay, a guy like David Tepper, he was taking heat. You can look at the filings. The moral to the story, to myself, is, and Julian hit it right on the head, they're investing, they have to invest for the long term. They have no choice. All right. It's more than just the cash flow model. It's making the proper risk reward decision or the bet if they're right or if they're wrong. Okay. When you see a company like Oracle, Safra Catz is unequivocally, categorically a brilliant person, of what she's been able to do. And now with the negotiations with TikTok, and how they're going to be influencing it, it's just another thing they're putting on the menu that they have for their diversification. Now, one of the markets that I'm really looking at is the energy market. And this is what I'm seeing in energy. There's no question in my mind, for me, that fossil is not dead, but it's such a psychological barrier at the pump based on adjusted inflation. And more importantly, we've seen that EV is not where it needs to be. Number one, categorically, Tesla isn't selling as many vehicles, but he's such a bright guy that he can manifest it in many ways as a tech company, as all other different things that he can manifest. But the reality is this: the Japanese said no, and they built probably the best car in the world, in my opinion. And that's a fact. All right, and those are the facts. Now, as far as the Chinese, okay, with EV, it's still not there. It's just not there. It's not there. If you talk to anybody who owns the common guy who owns that vehicle, it's just not there yet. In a place like Quebec, they export electricity, they sell electricity. It doesn't work well in cold weather. It's not there yet. And when it's too overheated, it doesn't work.
So you think the oil is definitely going from the current level 60 something to the 70s in Q4? That's maybe your call?
My call is as follows. There's a much better probability that oil will see 70 before it sees 58.
Okay, fair enough. Changing the topic to Julian. Julian, I'm MI2 Partner, is a global macro research house, and you have to deliver actionable ideas to big guys. Big guys are not seeing the market every day. They're basically relying on their own analysts and guys like you, advisors, that come say, hey, watch this correlation, such and such might happen because this is the end game when this happens. What are you seeing today that you can give to the audience as a potential actionable idea that you think is have a lot of opportunities to happen in the near future?
So Victor, look, our view is that we're at the beginning of a structural bear market in the dollar. And from a macro perspective, that is absolutely the holy grail. It defines profits for every virtual asset price movement for the next 5 years, right? US investors in equities may go, I don't really care. You're wrong. You are so utterly wrong. If you look at the last down cycle in the dollar from 2002 to 2008, tech, consumer discretionary, healthcare were the worst performing sectors. Oil, mining and metals, gold were the best performing sectors. So if we think, which I do, right, that we are the beginning of, it's not the end of the dollar as a reserve currency. This is just a standard dollar 40 to 50% cycle decline. We've seen 3 of them since 1970, right? We could be setting up for, and I truly believe this, a rotation of biblical proportion in that the last become first and the first become last. And I do believe that there is an entirely likelihood that the whole setup between the US market and economy is a reflexive cycle. And if that is correct, Victor, and reflexivity in the true Soros meaning of the word, that the purchase of the asset underpins the fundamentals that drive the price of that asset. So in other words, the more you buy, the better it gets. I think that applies right across the US economy, right? From AI spending to everything, right, is all driven by asset prices. That if we are at the beginning of this cycle turn, right, and the dollar is an integral part of, dollar strength is integral to that reflexive equation, okay, that we are going to see some enormous changes. So what have we've been long? We've been very long gold, right, for a number of years. We have been generally, short the bond market. I think we are in a period of higher inflation. We trade it, okay? We just went short at, 4% on yield, so long yields, short the bonds, right? I think if I look at the market right here, though, right, things are looking a little stretched. I am worried when I look at the number of rate cuts that are priced into 2026, right, relative to 2027. Now, I think there's reasonable odds of a recession, but I wouldn't put them higher than 40%. I would put the odds of a reacceleration, particularly if the administration gains control of the FOMC and we get accelerated depreciation allowances. I would put the odds of a reacceleration and ensuing inflation at also at 40%. So this is quite a delicate time, Victor, to be pushing big bets. We've had really good runs. We caught dollar weakness at the beginning of the year. As you know, we were one of the few shops that said US equities will go down and the dollar will go down too, because everyone and their wife and dog and cat is long dollars. And that remains the case. They've hedged some, but broadly speaking, the world is long dollars and stuffed up with dollars up to their gills, right? And so when we get a dollar decline, we haven't even started to see the rotations, right? You haven't even started to see the rotation. You could buy the whole of XME, which is the mining and metal ETF, with 3% of the tech ETF, AUM. 3%. Right?
Absolutely. Yes.
In 2008, that ratio had risen to 25%.
Wow.
Right? So these can be 10-bagger trades going forward. And it'll be great for your listeners in Latin America because emerging markets will do exceptionally well, right? But we have to see the break on the dollar. And the dollar has come down to key trend lines, multi-year trend lines. But given today's data, it's bouncing off them, right? So yes, that's one of the rules of being advising hedge funds is knowing when to push the bet, having stops, knowing when to get out, and living to fight another day.
Well said.
Steve, let's finish the podcast with yourself with some sort of a positive note, because I'm always a perma bull. Obviously, if you see that the explanation that Julian gave us, I still see opportunities because of the devaluation and perhaps some sort of revaluation in the emerging markets. So maybe the stock market will do that biblical rotation, but we keep seeing the Dow Jones going up. What do you think about all those opportunities? Because at the end of the day, remember, we're going to revisit this, Julian, revisit this, Steve. And one thing is completely, important for the future. Everything will change. We don't know what it's going to be, this U.S. market and everything that's going to happen within the next few months. But obviously, we are in very important times. What do you think, Steve?
Well, let me just say this. In being in this business since, literally 1988, 89, I've seen the dollar at 136, the sterling at 202, and gold at 500, and interest rates at, 8. The world doesn't collapse. But what I will say, now with the alternatives and the potential, cashless society that we're coming into, we're going to see a lot of potential movement with liquidity. You see, what makes the U.S. markets so powerful on all the other markets, it's the liquidity. When you go to other markets, whether it is the Bovespa, whether they're just not liquid. Okay, they're just not liquid. All right. So therefore, where are you going to put your money? In a place that, in a place where you can get out, all right, and endure the pain if you're going to take pain. But the public needs to understand, and this is what I firmly believe. Of course, we're going to go down 3, 4, 5% here, but that's normal. I mean, that's just a normal progression. But coming back down to what Julian said, it's what you're buying and the value you're buying it at. And that's going to always be the devil in any detail, in anything. So I see a pullback. I see a lot of potential opportunity, all right, in things that have got beaten up, like pharma. Some of it has gotten killed, but some of it has not. All right. So it's always going to be in being diversified and not owning too much of anything ever. You just can't. You have to have somewhat of a longer term approach. I'm not saying have an approach like Warren Buffett for 30 years, but a reasonable approach. Reasonable. And that comes within you, all right, as an investor, of what you feel comfortable with and what you can and cannot tolerate.
Steve, thank you very much, Julian. Thank you very much. Y bueno, como les estoy diciendo, Julian and Steve will be, I know Steve will be pretty soon, but Julian will be also interviewed by me from the floor of the New York Stock Exchange. Julian, you got to say yes, because obviously I want to have the ability to see you there in the exchange. And as you can imagine, this is extremely important for me. But in any case, thank you to both of you. Muchísimas gracias. Y ustedes van a ver todo lo que va a pasar basado en esas predicciones. Muchas gracias.
Thanks, Victor, and congratulations.
Yes, really good. And Julian, always pleasure seeing you and talking to you. Wonderful seeing you, Julian.